Monday morning is going to be interesting. Now, what started off Friday was the Chinese announced that they were putting restrictions on rare earth exports to the rest of the world, which triggered a retaliation of sorts, at least the intention to retaliate from the United States and placing big tariffs on Chinese products. And it was off to the races from there. We had commodities that crashed, oil down, gasoline down big time, flight to safety, everybody piling into US Treasuries, the 10-year US Treasury yield falling about 11 basis points, stocks down, basically liquidations throughout Friday afternoon. There are a lot of financial participants that are sweating this weekend, hoping that maybe, just maybe, the US and China are posturing and will get everything worked out by the time everything opens on Monday. And that's not all. We've got the ongoing saga with Tricolor, and more so now, everybody's paying attention to First Brands. The credit markets are cracking because the combination of bad economics, meaning the labor market, along with everything that's happening in terms of liquidity, tight money, lots of questions about where everything is going. Suddenly now everybody's interested in what the credit markets have been up to the last couple of years, when before now nobody could care less. Everybody just lent and said, okay, Jay Powell's right on the economy, everything's moving in the right direction. Then all of a sudden you've got all of these things seemingly hit at once, and everybody's hitting the pause button as fast as they possibly can, just saying, let's hold up here and see how everything goes in the short run. But that's not how markets work. Markets work like the proverbial shark that needs to always swim in order to gain oxygen and continue to breathe. Markets need buyers all the time, and pause buttons are not good. So we have a major thing happening. We'll see how it opens on Monday. See how the markets go on Monday with all of this uncertainty over the weekend that doesn't seem to be getting any better. Liquidations already on Friday, and those do tend to carry over through the weekends. So, Steve, Mr. Van Meter, what is your take on all this? I mean, we were not in good shape to begin with. Let's be honest. I know the stock market was soaring, but we've seen a bunch of stuff that has really started to show up. Really going back to the payroll report that we did a couple months ago, the July payroll report in early August. That sort of started to trigger the snowball down the hill. And now you throw on top trade wars 2.2. That's a lot to take all at once.
Yeah, Jeff, I think the indicator for me last week, there were two things that stood out. One, I know you did a video on repo fails recently, and I thought that's really interesting because that's telling you there's stress in the system. And then the dollar started to rally a bit, and I'm like, aha, there's some validation here that people want to hang on to dollars. The notion that the dollar is no longer a safety trade, well, that's not true. It is. Now all of a sudden people want dollars, they want their collateral, and to me that was a sign. Now, of course, we didn't know President Trump was going to make this announcement on Friday after markets closed, going in to a holiday weekend where banks are closed on Monday, not the markets. But nevertheless, there were some early warning signs that, hey, there's some problems under the system that were exclusive of this issue with China. And I think that's what kind of you're saying here is, look, we have an issue with the credit markets, and now we have 2.2 of the trade war going on, and we've got some major problems here that the market kind of already knew were coming.
Yeah, that's a good point, Steve. The dollar rising, because the dollar's been rising for the last several months. It goes back to early July. I mean, the Sell America thing, that was everybody's rage in May and into June. But as soon as we got to July, a lot of things began to turn around, which suggested already back then that the markets were taking a very different tack on where everything was heading, and perceptions about risk, and more than just in the marketplace too. Macroeconomic risk, as we've talked about, the labor market in the US is going to be a big one, because that's going to generate and that's going to lead to potential delinquencies and defaults and all the bad stuff that the credit markets are thinking about right now, even before we get to First Brands and potential fraud and improper hypothecation and rehypothecation of collateral. I mean, there's a lot of stuff that happens there. So it's like coming from all of these different angles. You've got the markets that have already been in defensive mode to begin with. That's the dollar rising. That's interest rates falling, treasury yields, bull steepening on the curve, dealing with macro considerations. I've been talking about all of these Eurodollar signals, dollar tightening signals, whether it be, as Steve pointed out, repo fails. There's a big increase in securities lending by the Federal Reserve. There's also a lot of U.S. Treasury reserve assets that are held by foreign official institutions that were suddenly sold since the beginning of August there too. So I mean, it's dollar funding difficulties that are rising with the dollar, flight to safety with U.S. Treasuries, and along comes China, the United States reigniting maybe even a more severe reaction in terms of trade wars. Monday's going to be really interesting. That's all I got to say. Before we get back to everything with Steve, just a reminder, this upcoming Tuesday, October 14th, 6 p.m. Eastern Time, webinar. We need to understand the interest rate market and what interest rates are telling us for what should be increasingly obvious reasons. Mainstream economics, central banks, they leave you in the dark. They either tell you misinformation or they're just plain wrong and backwards about interpreting all of these key critical signals. Well, we're going to start to change that on Tuesday, October 14th, this coming Tuesday, 6 p.m. Eastern. There's a link in the description to sign up for a webinar. It will be well worth your time to attend.
Yeah, particularly Jeff, because you look at the dollar. I mean, we're talking a massive foreign currency exchange market, to the tune of somewhere around 9 trillion a day. And as you know, shorting the dollar and buying, well, anything, crypto, tech stocks, commodity, anything, just sell the dollar and buy everything else because you're going to get rich. That trade's coming to an end. And if we see the dollar push up on Monday, and I think it's going to head higher early in the week, you've got a lot of people that need to short cover. They're going to be buying back the dollar at a higher price. And that means they've got to liquidate other stuff. So people might say, this is a one-day issue. It doesn't appear that at all. And then you've got, systematic machines. They're going to have to sell. The VIX is going up. So you've got a lot of things that could really exacerbate this in very short order.
Steve, are you saying there was a lot of crowded trades? Is that what you're trying to get at? Because I think I agree with you that point. I mean, this summer, everybody was convinced. Long U.S. stocks, long crypto, short the crap out of the dollar, short the crap out of U.S. treasuries, right? I mean, that's what everybody did. And you heard it over and over and over again. You see it on basically every other tweet on X. Social media is flooded with all of these, everybody posting their trades, right? Like, I've been shorting the hell out of the dollar and making tons of money doing it. So then you throw in all of these unexpected issues into the mix, and suddenly it's like, oh, crap. Everybody's been leveraged in the wrong direction. And as we know, as the markets always test the market, test participants and test everybody, you go through these reversals where people think that they're on the right side of the trade and find out they're on the same side of every trade as everybody else. And that the exits that you thought were going to be there to get out of, suddenly they're like this and this and this. And they get narrower and narrower and narrower. And eventually they disappear altogether. So you have all of these leveraged positions. You have everybody thinking the wrong way. And by everybody, I mean at the margins, because obviously the marketplace has been thinking differently. But at the margins, all of these trades are going to have to be cleared because everybody's going to be panicking all at once, which is exactly what we saw on Friday. I think that's why the reaction in the marketplace was so violent, is people said, uh-oh, I better get the hell out of this while I can. I can't even wait till Monday. I got to get out today. So like I said, Monday's going to be really interesting.
Yeah, Jeff. And then you tack on, what happened in crypto. You're talking $19.2 billion eviscerated, wiped out, gone, accounts going to zero. I mean, some cases, and because you've been in the business before, you don't see negative account balances very often, but that's happened because, you read some of these stories and people are like, yeah, you know what? I was falling a little behind, so I started adding leverage. I started making more money, so I started adding leverage. And next thing you know, these people are running 10x, a small, tiny move to the downside, and you're at zero. And so I think a lot of people are going to find out that Monday morning, there's going to be even more liquidations. And, you look at any asset class, whether it's crypto or anything, the last thing you want to do is see people get wiped out, because if anyone's out there thinking, hey, you know what, I might put some money in that, and they see other people going to zero, it's a good way to get people to not invest. And as more people, as you said, run to these exits, and they're getting narrow because the leverage just isn't in the crypto space. There's a chart of leveraged ETFs, asset under management. It's at record high, not a little bit, but it's way off the charts. So you can think, Tuesday, the banks are going to open. There could be margin calls. There could be a lot of resets happening here. And all the question is President Trump, President Xi, are they going to get together in between now and the Apex meeting, or are they not going to meet at all? We don't know. But as you know, markets really hate uncertainty. And at the moment, there's a lot of it.
Yeah, there's a lot of people sweating right now. They're thinking, "Oh my God, what's going to happen between the next?" I mean, thinking that maybe just like April, there'll be some last minute rescue from China and the United States saying, "Oh, we've come to some short run agreement." Maybe this is just posturing. They, using the maximum amount of leverage that each one has on the other one, just trying to get a better deal. I mean, maybe that's the case. Maybe this is all just negotiating tactics under the hood. But even if it is, that's the problem I keep getting to. Even if this is nothing more than China and the US rattling their sabers to try to get the best possible deal arranged it still doesn't erase all the other things. It just takes one more thing slightly off the table. This is not really about trade wars 2.2. This is really about the underlying macroeconomic situation and the fact that the credit situation has been less than ideal. Let's say that for at least a couple months now, and that on top of all of that, there has been a massive amount of risk taking in places like stocks and crypto that has been predicated on, I mean, the Goldilocks of the Goldilocks possible scenarios. So it's all of these things have been undermined over the last couple of months, and it's not just the trade wars. The trade wars is just one more thing that's thrown on top that just got everybody's attention because the markets were already moving in that direction. Like you said, we talked about the dollar, the treasury market. People were moving in that direction to begin with, and so you throw one more thing in there, it really does look like the straw that breaks the camel's back. So there is a very good possibility in the short run that the next week here looks a lot like it did in April, where things are being liquidated in more chaotic fashion, leads to disorder. I mean, Steve, as you're saying, disorder leads to more disorder, leads to more disorder, because even people who would buy and say, I'm gonna hunt from some bargains, they're gonna sit on the sidelines and say, okay, no, this stuff can go quite a ways. We're just gonna sit back and just let it all kind of fall before we start to really step back in. And the one thing I really want to point out here is that the macroeconomic situation, the market situation, the monetary situation here in October is materially worse than it was in April in every single way. You think about the U.S. economy, the labor market today, people agree that maybe the U.S. is already losing jobs. We're back in April, as Jay Powell kept saying, strong, resilient, solid. So there is a lot that is much more fragile, to put it kindly, here in October than there was in April. So this is going to be interesting.
Yeah, for sure, Jeff, because you mentioned payrolls. As you know, Waller's come out here just this last week and said, look, I think they're negative, and there's a good chance. And you said the same thing, that, hey, I think after the revisions, eventually we're going to see that there's some negatives here. But if you're a business right now, it's not just about stock prices coming down. It's not just about crypto coming down. I mean, the markets go up and down. That is that. But if you're a business and you've been looking for this second half rebound, you're not seeing it. If you've been looking for the trade war to come to an end, now you're finding out it's escalating. Now, and even if this is all just posturing, like you suggested, and that maybe none of it's going to happen, it doesn't matter. In the interim, it's going to spook people. Spending is going to drop because people are going to say, look, I don't know if I'm going to have a job. So for businesses, I think if they were thinking about laying off, or they were, even maybe kind of on the bubble if they had to or not, this is going to give them a clear path to say, hey, you know what? We can't handle 130% tariffs. So you're going to have to lay more people off. And then you look at the broad economy, it's already decelerating. Trump announced that, hey, we are laying off more federal employees. They're going to be permanent. You potentially have negative payrolls, and you have a weak holiday season. And it starts compounding to the point where, at what point do consumers just stop spending? And, when you're watching your accounts go to zero, or at least your friends go to zero, and you start worrying about your money, well, you cut your spending. And as you know, Jeff, once that happens, it's game over for the U.S. economy.
That's the possibility here that's behind everything. And so if that's it doesn't even have to be the base case, right, Steve? It could just be a non-trivial possibility, because everybody beforehand, the last couple of years, everybody said the U.S. is the rock. It's the pillar upon which the entire global system rests upon. So any questions that came over the last couple of years, people say, oh, okay, yeah, maybe that's a big deal. Maybe that's an issue, but we got the strong U.S. economy over here. Let's lend. Let's do everything positive. Let's do all sorts of risk taking in the U.S. economy. But suddenly you take that away, and now you're faced with some of these, First Brands is a big one. I think it's going to turn out to be much bigger than most people realize. That comes along, and no, you don't have the U.S. economy to depend on. In fact, if anything, with the job market situation being what it is, what we think it is, and what we're reasonably assured that it is, that's going to raise delinquencies. It's going to raise the potential for defaults. So you've got a bad U.S. economy that plays into a credit market that's now saying, what the hell just happened here? Because in any type of credit situation, any modern credit industry, collateral is the backbone of everything. And once you start doubting collateral, there's no faith left. I mean, collateral is the substitute for faith. I mean, this is exactly why.
Didn't people not want dollars or treasuries? Isn't that the collateral you want? That's what's really interesting right now, is all of a sudden people are saying, I need collateral because it's the only thing I can put my hands on.
Yeah, the dependable sources of collateral. The collateral I'm talking about is just, the junk that floats around the edges that people use lots of time. It's just, what is First Brands? What were they putting up as collateral? They were putting up their invoices. And in the auto business, it kind of makes sense given where the auto business has been over the last, several months at the very least, that they're maybe, skirting some guidelines and rules and maybe using invoices in a couple different places, just trying to stay afloat, hoping that Steve's second half rebound actually does show up. But my point is, what made the 2008 crisis turn into the 2008 crisis? And I'm not making a direct comparison here. What I'm saying is the big issue there was once the system started to doubt the lesser quality collateral that floats around the edges, that was it, because there's no going back from that. So I'm not saying we're that far here with First Brands, but you have all of these negatives that are taking place, and we do know that the banking sector right now is saying, hold up here. We need to stop and take a second and reassess, whether it be Trade Wars 2.2 or really First Brands or the U.S. labor market and the U.S. economic situation. There are any number of reasons for the banking sector to say, let's hit the pause button here at the very least and just to reassess where we are. And I think, Steve, you agree with me here. As banks do that, what they're going to find they are not going to like. And I think a lot of them already know that. So it's more than just a pause here. It's a pause here to reassess and then say, oh shit, this is the big one, or this is really going to lead us in the wrong direction. That's the possibilities that we're facing here that didn't seem to be possible at all to basically most of the stock market and the risk markets like cryptocurrencies just a couple months ago. Now all of a sudden, all of these things are realistic and possible. That's where you get these liquidations in short run basis like this.
Yeah, Jeff, I think the banks have a lot of reasons to push pause there. And I don't think it's just a First Brands issue. And that's going to be one where they're going to ask and say, hey, we have this collateral or this loan against something. Are we the only ones? How many other people are holding the same note? And I think that's a real issue. And I think that's starting to spook the banks here a little bit. But that happens in boom times when there's so much money being flooded by Wall Street. It's just lend and lend and lend and then ask questions later. But on top of that, they've got the slowing economy. And if they think the trade war here, this escalation is going to lead to further layoff, well, they're going to tighten lending standards up. And then you tack on, of course, asset prices. Well, people borrow against their accounts. Well, all of a sudden you got to raise those margin lines up because if their accounts go bust, well, that means you're going to hold the losses because odds are they probably don't have any money. So I look at the bank's positions here, and then you find out, well, maybe they're probably short dollars too, that all of a sudden there's a big reason that they could step back and say, hey, you know what, we want to hold up. And right now, you talk about freezing up credit at this time in the game. I mean, but this is what always happens. It's not a good thing. It's just the reality is the banks don't want to go under here. And there's some very real risks that, we could be facing a whole nother credit crisis.
There's all sorts of stuff going on beneath the surface that everybody just covers up and papers over so long as they think the U.S. labor market is strong and resilient. That really is the key and the trigger, which is one reason why, Steve, you and I have been we've been harping on this all along. We kept saying, when you start to see the negative payroll reports, that's going to be a bigger deal than just people getting laid off. Not that, we're not dismissing or downplaying people getting laid off. That's obviously bad for the economy. But when you have overextended credit and leverage in all of these, and it being rationalized in these ways, right? I mean, that's what it is. The last couple of years, everybody kept saying, we could see the economy was not good and it wasn't strong, but everybody, who cares? We don't have layoffs. You don't have job losses. So consumers are going to keep spending, going to keep making their payments. We've seen delinquencies rise. And what happens? The shadow banks in particular, they kept on lending and lending and lending. And they did so because they thought Jay Powell was right about the labor market. It's strong. It's solid. Therefore, we're not going to have to worry about delinquencies. We'll be able to cover everything up and paper everything over. But once you get those negative payroll reports, that is the bright, flashing warning that goes all across the sky that says, okay, everything that you thought you knew last month, last year, that's all out the window. Everything has changed. So once you get that to that point, and then you have all these other negatives on top, at the very least, we should expect people to begin, I don't want to use the word panicking, but people that are going to hey, let's get the hell out of our positions. At least get out of some of those positions because there are just too many negative factors on the table right now. And so that's what happened Friday. We got a little bit of taste of people getting a little bit panicky about, okay, trade wars 2.2, that's not going to be good. Labor market's got negative numbers to it. We got First Brands and all sorts of questions on collateral. These are big, big things. And not a lot of people are going to just stand there and take it. They're going to move toward the exits. And so for the next little while, I think we should expect quite a bit of volatility.